So I gave you guys an example when we talked about Target or Sam's Club, and we talked about the difference between a retailer, a reseller of merchandise, and a service company. As you can see, just in comparison, a service company like a doctor or auto mechanic or someone of that nature, a service company basically provides a service. That's how they generate revenue. Whereas a retailer sells a good. Here's a distinction. Service company, all you have is operating expenses. Merchandiser or retailer, you have cost of goods sold. This represents the cost of the inventory that I am selling. Again, this is the sales price of the inventory that I'm selling. This is the cost of the inventory that I'm selling. These are my watches that I'm selling at $1,000 a piece. This is the cost of the watches that I'm selling as well, to arrive at what's called my gross profit or my markup, all right? Also known as the markup on what you have sold. So understand that a service entity will not have cost of sales because they're not selling a good. They are providing a service. The way that they generate the revenue is that they provide a service. The other side is a merchandiser or a retailer who is actually selling a good. They are selling something that they're marking up. Doesn't make sense for you to sell something for what you paid for it, because then what? You don't make a profit. You sell it for more than what you paid for it so you can make a profit. That profit, that gross profit, is your markup. All right, now we're going to get into the accounting for that inventory, because the bulk of this chapter deals with the accounting for that inventory. And in accounting for that inventory, there are two methods that we're going to talk about. One method is called the perpetual method of valuing the inventory. The other one is called the periodic method of valuing the inventory. And the way that I want to describe these two methods is that one method involves a constant update. As I buy inventory, it gets added to the inventory ledger account. As I sell inventory, the ledger account then is decreased, cost of goods sold is increased. So the buying and the selling constantly updates both ending inventory and cost of goods sold. Let me repeat that. As I'm buying inventory in the perpetual method, I am constantly increasing the ledger account for inventory. More inventory increases the inventory balance. As I sell it, I am decreasing the inventory balance on my balance sheet and then increasing cost of goods sold on my income statement. As I continue to sell, my cost of goods sold will continue to grow because now I am reducing the inventory on my balance sheet and increasing the cost of goods sold on my income statement. That's the periodic method. Constant increases for purchases, constant decreases of inventory on the balance sheet for sales, with a corresponding increase in cost of sales on the income statement. The periodic method requires what's called a physical count. Under the periodic method, sometimes stores will close down for a period of time, sometimes late at night, sometimes a day they will close the store down so that they can get all of their salespeople out on the floors to count what's on the shelf. That's called a physical count of inventory. I want to know how many rolls of toilet paper, how many rolls of paper towels, how many eyeglasses do I have in the case, how many cameras, how many iPhones. I am physically counting all of my inventory. That there provides me with a true ending balance of inventory. It's generally done at the end of a fiscal period or end of a calendar year. They close the store or work on a weekend so that they can physically count what's on the shelf. That will provide the retailer or merchandiser with a true ending balance of what's in inventory, what's ever on the shelf. That will help them then, as you will see shortly, help them to calculate the cost of goods sold and the ending inventory. Where does cost of goods sold show up? It shows up on the income statement. Where does inventory show up? It shows up on the balance sheet. These are the same things. It is inventory. One is the cost that goes on the income statement. The other is the ending balance of inventory that's on the balance sheet. Same watches. Same watch in inventory, same watch in cost of sale. All I'm doing is taking my cost of inventory and placing it on my income statement. We'll show you how that works in just a moment.